when the metals start accelerating. That when the gold-silver ratio comes down and silver goes up faster than gold, that's when you're entering the acceleration phase. And that is normally led by silver. And I think that's what we're going to see now too. Silver has now moved up to $36. 35 was a bit of a critical resistance. I think we'll move quickly above $50, $60, $70 very quickly. And again, I'm not a speculator. I'm a long-term, not a preservationist, but I think silver is now an opportunity. But hold more gold than silver, but hold some silver too, because that's going to give you an interesting ride. And I think silver will go up manyfold, manyfold.
Silver prices continued their upward momentum on Friday, supported by falling Treasury yields and a weaker US dollar. Safe haven demand remained strong amid ongoing tariff uncertainty, dovish commentary from the Federal Reserve, and signs of a weakening labor market. These factors have helped silver maintain a solid technical footing near key resistance levels. Egon von Greyerz of GoldSwitzerland highlights the importance of silver recently breaking above the $35 mark, a level that had acted as strong resistance. Once silver breaks these kinds of levels, it tends to move fast, and $50, $60, even $70 could be around the corner. While von Greyerz isn't advising investors to abandon gold, he emphasizes that holding physical silver at this time could offer significant upside. The rally may be just beginning, as long-term structural demand, particularly from industrial and green technology sectors, continues to support silver. UBS has forecast silver reaching $40, while some analysts are setting bold targets as high as $100 to $130 per ounce. Von Greyerz also draws attention to the broader context for precious metals, noting that the total value of central bank gold reserves, approximately 36,000 tons, is only about $3.5 trillion, roughly equivalent to Microsoft's market capitalization. That's completely out of balance, he says, suggesting that gold is due for a significant revaluation to reflect the vast amount of financial assets now circulating globally. Central banks have increased their gold holdings by over 1,000 tons annually for the past 3 years. Last year marked the third largest expansion on record, continuing the aggressive accumulation trend that began in 2022, which itself was the highest level of net purchases since 1950. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
Gold is the king of money. That's the real money, real money for wealth preservation, gold. But right now, we definitely see an opportunity with silver because we have over certain periods told our clients don't hold silver because it's too volatile. You won't sleep at night. But right now, the ratio has now topped recently at 100, coming off quickly by almost 10%. The gold silver ratio. Gold divided by silver. And that's a measure of when the metals start accelerating. That when the gold-silver ratio comes down and silver goes up faster than gold, that's when you're entering the acceleration phase. And that is normally led by silver. And I think that's what we're going to see now too. Silver has now moved up to $36. 35 was a bit of a critical resistance. I think we'll move quickly above $50, $60, $70 very quickly. And again, I'm not a speculator. I'm a long-term, not a preservationist, but I think silver is now an opportunity. But hold more gold than silver. But this is an opportunity because silver is also, they say the poor man's money. You talk about tokenization. Silver is ideal for tokenization because if you have 100% proper operators with 100% backing of the metal, that is an inexpensive way of distributing physical silver to a bigger public which cannot afford to go or find it difficult to go in and buy one silver coin at a time, maybe some. So I think silver is, but physical silver, of course, that's what we do. We don't do token gold or silver. But now hold some silver too, because that's going to be an interesting ride. And I think silver will go up manyfold, manyfold. And I stopped giving forecasts in any currency or any metal at all, because for the simple reason that it's meaningless. Because if you tell them a number in $10,000 $50,000, whatever. And, what's the dollar worth at the time? That's or the euro, whatever. That's really what counts. So just having putting a dollar value on something, measuring it in money that goes down by the day is meaningless. So therefore, I know that the metals are going to appreciate substantially more than inflation. And that's enough. You don't actually need to have a target by end of the year, whatever it is. It's useless to have that. But the multiples is going to be what's going to happen measured in paper money. Sorry, I just wanted to mention silver because it's important to understand also silver is now interesting. The problem is that you cannot get rid of debt. You can cancel debt, but if that debt is backed hundreds of trillions of assets, if you put the debt aside, those assets are going to lose the same percentage of their value as the debt does. And therefore, because the debt was backing all of those assets in an incredibly leveraged fashion,
Right.
and therefore, there'll be an implosion of assets. And we know we have bubble assets today. You take central bank gold. Total central bank gold in the world is about 36,000 tons, not a lot. And the value of that is just a bit over $3.5 trillion. The value of Microsoft is $3.5 trillion. And that shows you one US corporation is worth as much as all the central bank gold in the world that is backing the monetary system. Hey, then you realize that something is wrong in relative values in the world. And then you realize that gold needs to be revalued by multiples to adjust for this total incorrect ratio between bubble assets and real money. And that's going to happen. We're in the midst of it, since we started in 2002 at $300, advising our clients to go into physical, and then we set up the system, doing it outside the banking system, and helping them buying, storing it in their name, etc., in Switzerland and Singapore, since then that was $300. Now we are 3,300, so we're up 11 times. Some other currencies were up more, but this is just the beginning. I'm not a gold bug at all, as you know. We just went into gold because I saw the risks in the world. I've always been interested in risk and protecting the downside against the risk that I see. And I saw with the debt growing and during Greenspan's time, etc., and in the 90s, I said that this is going to end badly, like it always has in history.
Right.
Without fail, every single monetary system has gone to zero. So it was pretty easy, and we are, that's why when we started this discussion, it's so fascinating to be watching this because it's happening. It's not, for us in the middle of it. It's in slow motion. When you read about it afterwards in history, say the gold went up 10 times in 25 years. I mean, it's nothing, of course, but we are going to see, as I said, we are going to see it going up by multiple. And this is why we're back to what you and I are passionate about, and that's helping people to preserve wealth. A lot of people, will have a massive inflow into gold, of course, but it's only going to be marginal in relation to the total global financial assets because the gold market can't take it anyway. But if we go from 0.5% of world financial assets into gold to 1 or 1.5 or 2%, that will mean a massive increase in the value of gold, and it cannot be satisfied, this demand, as we know, by producing more gold, because we can't produce more than 3,500 tons from the mines every year. So it can only be satisfied by much higher prices. That's not a dream, that's reality, because we know that, and the central banks are gradually moving their reserve assets from dollars to gold. They're not going to do it overnight. They're not going to put pressure, too much upward pressure on the price. They're going to do it slowly, but that's a move that's going to make gold go up by multiples. This bar in 1971 cost $14,000. $14,000. It's 400 ounces, 12 kilos. And that was when gold was 35 dollars an ounce before Nixon closed the gold window. Now, today, that bar is worth just under $1.4 million. So that's up almost 100 times since 1971. And as we try to explain and keep telling investors, gold isn't going up at all. It's the value of your money that's going down, and nobody understands that. And the government doesn't want to tell you that because it does show their absolutely useless management of the economy. If they say, well, sorry, the value of your money is going down in your pocket. As Nixon said, the value of your dollar is still going to be the same after we close the gold window.
A recent report from the Brookings Institution warns that the ballooning U.S. federal debt, now standing at $36 trillion, could eventually trigger a severe financial crisis, not just in the United States but globally. While the likelihood of an imminent collapse is still considered low, the report points to the repurchase, or repo market, as the most probable transmission channel. This market, where financial institutions access short-term credit, is a crucial pillar of liquidity for the global economy. Egon von Greyerz underscores the same concern, noting that the U.S. is sitting on an exponentially growing mountain of debt. The deficits are massive, he says. Every year, trillions in new debt need to be issued, and the only reliable buyer left is the Fed. That's a closed loop, and it's not sustainable. Eventually, you run out of balance sheet tricks. His view highlights the precarious situation in which monetary authorities are effectively monetizing government debt, thereby further inflating financial imbalances. For years, many dismissed concerns about U.S. debt, arguing that as the world's leading economy and issuer of the global reserve currency, the U.S. could always count on demand for its bonds. But confidence in that assumption is waning. In the current political and economic climate marked by geopolitical tensions, fiscal gridlock, and persistent inflation, there's growing uncertainty over whether investors will continue to view U.S. debt and the dollar as safe havens indefinitely. As the foundational credibility of U.S. fiscal policy continues to erode, the risk of dislocation in key funding markets such as the repo market is no longer theoretical. The world is watching closely, and should confidence break, the fallout could be swift and severe. Let's get back to the interview.
I would say that there was a technical adjustment of COMEX stocks. I mean, there was a massive shortage there, and they had to balance that. I don't think it was a fundamental switch at all of gold to the US. We don't see investors moving from Europe or from Singapore or from Dubai or to the US with their gold. If you look at now, if you talk to, for example, the Swiss banks, there's a massive inflow of American money. American wealthy investors want to move their money to Europe. No one of a sane mind is going to move money back into the US. The flow should go the other way. I agree with that. There is no safe situation in the world anymore, as there was, because of the geopolitical situation and because of the economic situation. There is just not a safe place. Nevertheless, I would prefer any day Switzerland having my gold or my money in Switzerland as opposed to the US. I am quite convinced with the finances of the US and the debt and the escalating debt or the exponentially growing debt in the US, that there has to be capital controls in the US. Because the dollar will be affected, and just like in Nixon's days, and that they cannot allow the dollar is only down, or the dollar index only down 10% this year. That's a start. It's going to go a lot lower. It never goes in a straight line, of course, but over time it's going to go a lot lower. And I think there will be a point when, now, number one, they will stop the outflow. Number two, because of the US has to issue trillions of debt every year with the growing deficits, that debt, there's one issuer of the debt, the U.S. government, and there's one buyer of the debt, and that's the Fed. So, which basically is, all incestuous, and therefore a debt that no one else is interested in buying is a debt that's going to go to zero in value. And the only way to stop that is to force U.S. investors to buy treasuries. And I think that is not unlikely that, they will say that the bank or X% of money in the bank has to be used for buying treasuries, and probably and long-term treasuries at a very low yield, or maybe no yield at all, and a balloon at the end of it, with the interest being paid at the end. That's not impossible in my view, because there's no other way of financing this um, growing or galloping deficit that we're seeing in the US now. And it's going to get a lot worse. The couple of trillion a year now that it grows by, that's going to be 5 trillion and more, 10 maybe at some point, for the simple reason that the economic situation is going to deteriorate. The tax revenues will come down dramatically. The outgoings, Social Security, etc., will go up, and then there'll be a lot of banks and financial institutions, etc., that need to be saved, and the money needs to be borrowed too. Anyone who buys any debt, and especially government debt, is making the most foolish investment decision they could ever make. Because number one, governments are never, never, ever going to repay that. And if they attempt to repay part of it, it will be with funny money, not with real money. So that the money will go down by massive percentages. Will be worthless, and therefore. So that's the debt, and they will not be able to afford the interest either. The interest is now $1 trillion on U.S. debt. That's going to grow dramatically. When U.S. Treasuries at a 10-year bottomed in 2020, I was clear that the cycle was going to turn to a long-term increase in interest rates and fall in bonds. I think that trend has only started. We're still only just below 4.5% on the 10-year Treasury. I think we're going to see, like in the 70s, and I remember it well because I was a younger man then. But I saw it. I saw interest rates. I was in the UK. I've told that story a few times, and had my first mortgage in 1973. And I paid for a while just 21% interest on my mortgage.
Yeah.
And I managed. And can you imagine how many people today could pay 21% on their mortgage? Not one person.
Not one person, but here's the difference. What did you pay for your first house?
Well, I paid, this is in the UK, and I paid £21,000, and whatever that was in dollars at the time. There was maybe a bit over $35,000 at the time. But and they had actually gone up, doubled in the last few years. It was still a high price that I paid, but that's nothing today. Of course, I've learned one thing, that you've got to be patient. So what we see, and you see the same, we see it early. We see the warning signs, and we think it's going to happen because we see it. But things that take longer than we expect, and especially now, as I believe we are at the end of an era. We are at the end of a monetary era, and an historical end, and I think it probably is the biggest bubble in monetary history, and therefore it will be the biggest crash. And that's not a crash just of the money; that's the crash of the economy. That's the crash of debt. It's the crash of the assets that have been financed by this debt, and it's been a crash of society also, because people will have real problems surviving, and governments cannot help them. So it will be misery.
Yeah.
The world will not go under. It survives, but a lot of people will suffer in the meantime. And then we have the geopolitical side, which doesn't look pretty at all. The war in Ukraine is not going to end quickly. Trump is going to end it in a few days, as we know. And now he's almost pulled out because he sees that the solution isn't that easy. And then, of course, the European leaders, which are as useless as all the leaders in the world today, especially in the West. I always say that leaders are instruments of the time. You get the right leaders for the right period you're in. So, for example, in the early 1980s, when there was an upturn in the economy, you had Reagan and Thatcher, that were the right leaders of the time to really build on the strong up move in the economy. Now you have a bunch of leaders who are there to finish this monetary era. So they need to be as useless as possible in managing their economies and in their decisions about people's destinies, about money, about taxes, etc.
Balance sheets don't lie forever, and neither do markets. As global liquidity pivots and the foundation of U.S. fiscal dominance shows signs of stress, precious metals are emerging not just as hedges, but as quiet verdicts on credibility. Silver's rapid acceleration past entrenched resistance levels is not merely a technical move, it's a signal of shifting sentiment in a system straining under its weight. At the same time, gold's comparative undervaluation against mega-cap equities and its aggressive accumulation by monetary authorities underscore a deeper recalibration of value. This isn't about market cycles anymore. It's about systemic recalculations, where tangible assets may soon stand in for trust itself. Could this be the early phase of a broader financial repricing, one where metal becomes measure and paper the liability? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.